Welcome, everyone. Today, we're going to do a deep dive into a topic that's, well, absolutely foundational if you want to understand how any business really works. We're talking about current liabilities. And trust me, getting a grip on this isn't just about crunching numbers. It's about learning to speak the language of business strategy. It's about making the kind of smart financial decisions that are going to define your careers, whether you become managers, investors, or entrepreneurs.
So, here's our game plan for today. First, we're going to start with the core definition, what I call the one-year rule. Then we'll take that theory and see how it works in the real world with a case study. From there, we'll get into the really critical stuff, liquidity. We'll even tackle a super common mistake that can literally sink a business, and then we'll pull it all together to show you why this is so crucial for making big decisions.
All right, let's start with something you all know. Think about the last coffee shop you went to. Behind that simple tap of your card, there's this whole complex web of financial promises. Does that shop actually have the cash to pay its baristas at the end of the week? To pay for the next delivery of milk and beans? To pay its rent? The answers to all of that, well, they're sitting right there on the balance sheet, hiding in plain sight in the current liabilities section. This isn't just textbook stuff. It's about whether that business can even open its doors tomorrow.
Now, to answer those questions like a real analyst, we have to build a solid foundation. So let's start with the single most important principle for sorting out these obligations, the one-year rule.
Okay, here's the official definition, and you've got to pay close attention because there's a really important little detail in here. Current liabilities are debts a company expects to settle within 1 year or one operating cycle, whichever is longer. Now, for most businesses you think of, like our coffee shop, their operating cycle, buying beans, selling coffee, getting cash, is super short. So for them, that 1-year mark is the golden rule. But what about, say, a winemaker? Think about it. Their operating cycle, from growing grapes to fermenting, aging, and finally selling a bottle of wine, that could easily take 18, maybe even 24 months. So in that case, a loan that's due in 15 months would still be a current liability because it's due within their longer operating cycle. It's a subtle point, but it's absolutely vital for doing a proper analysis.
So while that operating cycle thing is a critical exception you need to file away, for the vast majority of businesses you look at, that 12-month time frame is your go-to guide. This rule is your main sorting tool. When you're looking at a list of a company's debts, the first question you should always ask is this due in the next year? If the answer is yes, boom, it's a current liability. And that means it's a claim on the company's immediate resources that you can bet everyone, managers, investors, you name it, is watching like a hawk.
Theory is great, but let's be honest, it really clicks when you see it in action. So to make all this stuff tangible, we're going to follow a fictional coffee shop we'll call Fresh Brews Cafe. We'll walk through a few completely normal business transactions and see exactly how these liabilities pop up on the books.
Okay, scene 1. This happens every single day in millions of businesses. Fresh Brews gets a delivery of milk and coffee beans, the stuff they need to operate, but they don't hand over cash right away. The supplier gives them an invoice and says, "Pay me in 30 days." In that one moment, from an accounting perspective, Fresh Brews has created an asset, all that new inventory, and at the exact same time, a short-term IOU.
And that IOU has a name, accounts payable. It's simply the money a business owes its suppliers. And we classify it as a current liability because, well, look at the payment terms. 30 days, maybe 60, that's well within our 1-year window. And let me tell you, managing the timing of these payments is a huge part of keeping a business healthy.
All right, scenario 2. Now let's think bigger. The cafe wants to upgrade its espresso machine to serve customers faster. They don't have $5,000 just sitting around, so they go to the bank and get a formal loan. Now, this is different from the informal credit from the milk supplier. This is a serious deal with a formal loan agreement, an interest rate, and a very specific due.
This creates a liability called a note payable. The key phrase here is formal written promise. It's a much more structured, legally binding kind of debt. And again, we just apply our rule. Is it due within 1 year? The loan is for 6 months. So yep, absolutely. It's a current liability, no question about it.
Okay, last scenario, and this is one you just can't negotiate. Every time Fresh Brews sells a $5 latte, a little piece of that $5, the sales tax, doesn't actually belong to them. They're just holding on to it for the government. They're basically acting as a temporary collection agent, and at the end of the quarter, they have to add it all up and send it off to the tax authorities. This obligation gets recorded as taxes payable. It's money owed to the government, whether it's sales tax, payroll tax, or income tax. And because tax deadlines are frequent and set in stone, quarterly, annually, these are pretty much always going to be classified as current liabilities. And trust me, you do not want to be late on these payments. The penalties are no joke.
So there we have it. We've just identified 3 super common types of current liabilities: accounts payable, notes payable, and taxes payable. But just being able to name them isn't the point. As future business leaders, you have to go deeper. You have to move from what is it to why does it matter? Why do these numbers on a piece of paper have such a profound impact on a company's survival and strategy?
So let's just pause for a second. Put on your financial analyst hat. We know Fresh Brews owes money to its suppliers, to a bank, and to the government, all coming due pretty soon. What story is this starting to tell us? What does this list of obligations reveal about the risks and the pressures this little business is dealing with every single day?
And here's the answer. The whole reason we care so much about these is because it all comes down to one critical concept: liquidity. Liquidity is just a measure of a company's ability to get its hands on cash to pay off its short-term debts, those current liabilities we've been talking about. In the simplest terms, liquidity answers the most fundamental question there is: can this company actually pay its bills when they come due? And this slide really shows you the night and day difference. On the left, you have a healthy, liquid company. It's smooth sailing, they can pay their suppliers on time, keeping everyone happy. A big unexpected repair bill? No problem, they can handle it. They see a chance to open a new location? They've got the flexibility to jump on it. Banks love them. On the right, though, you have a company with low liquidity. It is constantly walking a tightrope. They're delaying payments, which damages trust. A surprise bill could be a total catastrophe. And forget about growth, they're just trying to survive. This is the real-world consequence of managing or failing to manage current liabilities.
Now, this brings us to a major danger zone. This is a trap that so many students and, frankly, a lot of new entrepreneurs fall into. It's the deadly confusion between being profitable and actually having cash.
I hear this constantly. A student will look at an income statement, they'll see that bottom line number, the net income, is positive, and they'll say, hey, this company is profitable, they're doing great. They make the assumption that profit automatically means cash in the bank. And let me tell you, that is one of the most dangerous assumptions you can ever make in business.
The truth is, not necessarily. The reality is far more complicated, and a company can look fantastic on its income statement and, at the very same time, be just days away from going bankrupt because it's run out of cash.
Let's walk through exactly how this nightmare scenario happens. Step 1. Fresh Brews gets a huge catering order. Awesome! Under our accounting rules, they record that big sale right away, and profits on the income statement look amazing. Step 2. But the client has 60 days to pay. That means the actual cash from that amazing sale won't show up for 2 months. Step 3. Meanwhile, Fresh Brew's own bills, the weekly payment to the milk guy, the monthly loan payment, are due now. Step 4. Because all its cash is tied up waiting for that client to pay, the company literally runs out of money to pay its own bills. Step 5. The result? A profitable company goes out of business. This is exactly why understanding the timing of cash, which is driven by your current liabilities, is a matter of life and death for a business.
And that brings us to our final and honestly our most important section. Why did we just spend all this time talking about definitions and scenarios? Because no matter what you end up doing in the business world, this knowledge isn't just nice to have, it is absolutely essential. Your understanding of current liabilities directly impacts everything. If you're a manager, you're the one on the hook for managing cash flow to make payroll on Friday and keep the lights on. If you're an investor, you're going to be digging into current liabilities to figure out the short-term risk before you buy a single share of stock. If you're a banker, this is how you decide if someone is worthy of a loan. And if you're an entrepreneur, this is an academic. This is the lifeblood of your company. It determines if your dream lives or dies. Let's actually put this into practice right now. Okay, I'm a loan officer at a bank. The owner of Fresh Brews is sitting across from me asking for another loan to expand. I pull up their balance sheet. The first thing I see is that their accounts payable are creeping up, and I see that note for the espresso machine is coming due soon. My first question is not, are you profitable? My first question is, okay, walk me through how you're going to generate the cash to pay your suppliers, pay back the first loan, and pay back this new loan all in the next 6 months. You see, the whole decision hinges on a deep dive analysis of their current liabilities and their liquidity.
So, I'll leave you with this question. A balance sheet is not just a boring grid of numbers. It is a dynamic story. It's a story about a company's health, its strategy, its risks, and its opportunities. And that current liabilities section, that's the chapter about its immediate survival.
So my hope is that after today, when you look at a balance sheet, you won't just see numbers anymore. You'll see the ticking clock, you'll see the pressure points, and you'll see the story that's waiting for you to read and understand.